Hey, what's up, guys? This is Marseille, aka the Property Pastor, coming at you again with another amazing video. Our mission here at the Property Pastor is to unlock the secrets of wealth building through real estate investing. And today we want to talk about a subject called seller financing or owner financing. But before we jump into it, I want to remind you guys to make sure you like and subscribe to our page. That way you're gonna be notified of when we publish new videos and be the first to have access to the beneficial content that we're giving out to investors and partners and friends and whatnot, so that you can grow your business and add to your toolbox. So let's talk a little bit about seller financing or owner financing. Basically, seller financing or owner financing is when the owner of the property essentially becomes the bank. And what they do is they will, instead of going to a traditional bank for financing, they will essentially extend the financing to the buyer and hold the note and basically collect the mortgage payment every single month. So basically, seller financing does not involve a bank. It only involves two parties. That is the seller and the buyer. You know, in a traditional real estate investment and real estate transaction, you're going to have a bank, you're going to have a buyer, you're going to have a seller, you're going to have a real estate agent. You're going to have so many different parties involved. But what seller financing does is it cuts out a few of those parties and just deals with an owner and a seller primarily. Now, you're still going to have insurance. You're still going to have deed transfers. You're still going to have a lot of the traditional things, insurance, stuff like that. But you will not have to deal with the bank right up front. So the benefit of that, obviously there's a lot of benefits to it, but we're going to talk about that some. But before we do, I want to basically describe the two different types of seller financing that I've used before. The first one is short-term seller financing. So short-term seller financing is basically going to be used typically in a rehab type of situation. So essentially a person may go and buy that property with the goal of fixing it up or adding tenants, adding value to it, then refinancing the property at a later date to essentially cash out or pay off the original owner of the property. This can also just be when the buyer doesn't have good credit. So essentially, if they're able to negotiate it, they may go in and get the original owner to extend the financing and give the buyer enough time to fix up their credit, go to a bank, and basically refinance at a later date. But typically, I use it more in a rehab type situation where I don't want to carry the full brunt of the mortgage, and I'll just go in and set up seller financing for about 2 to 5 years and give myself time to essentially increase through forced appreciation, rehab, and upgrades to a property. And then that way, when I refinance it later, I'm pulling all that money back out, cashing my seller out, my original seller, and having cash flow built in and all those kind of things. So short-term financing works really well in a rehab situation, or also if a person doesn't have the down payment or doesn't have good credit. But then there's long-term financing. So long-term pretty much bypasses the bank altogether. And essentially the owner would put maybe a 20-year, 15-year, 20-year, or even a 30-year note on that property and essentially collect, put an amortization schedule and collect monthly payments from that buyer. Now, the nice part about that for the owner of the property, the original owner / seller, is that they are still going to get a monthly check. They don't have to pay all as much of the capital gains from the sale of the property right away and whatnot. They're still going to get a monthly benefit check in the form of a mortgage payment. On the other hand, for the buyer, right, they don't have to deal with the bank, so it's much faster. They can go straight in and deal with the owner directly. They can negotiate any terms they want. So it's kind of a win-win, right? Because that particular the seller of the property may still want to get the money coming in each month, but they may no longer want the headache of owning that property. What happens in real estate is as folks start to get a little bit older, they don't want to be quite as hands-on. So they want to kind of take a step back, but still have the benefit of passive income. And that's where long-term financing really comes in and is very beneficial for an owner and a buyer in that particular instance. So let's talk about some of the benefits a little bit more detail, right? So in a seller financing deal, everything is negotiable. Everything from the rate, from the length of time, the down payment, late payment fees, everything's negotiable. It's basically two parties trying to come together and come out with a win-win situation for both of them. I like seller financing because sometimes what I'll do is an interest-only loan. And you may be saying, why would you ever do an interest-only loan? Well, the nice part about an interest-only loan, when you are holding on to that property and not generating cash flow, is that the principal is not something you have to pay every month. So say for example, like I did an interest only deal, a short-term seller finance deal, where basically I had a $150 interest payment during the time that I was going to hold on to this short-term seller finance loan. So in this particular instance, I had a duplex that I was doing. I was going to rehab one unit, and the other unit was pretty much ready to rent out. So I was renting one side, and then I was rehabbing the other side. Well, during that time, my payment was only $150 a month. If I had gone through a traditional bank, I would have probably been paying much more, 2 and 3, maybe even 4 times that amount through a bank. So what that allowed me to do was basically for $150, which is electric bill or whatever, I was able to go ahead and get into a property. Now we worked it out where I gave a down payment, which was less than I would typically have to do through a bank. And a lot of those diligence things that you have to do, a lot of the so you bypass so much, but everything's negotiable. You can also negotiate principal only loans, right? So from the standpoint of whenever you truly finance a property through a bank, you're gonna pay double what it actually is by the time you pay interest and you pay principal. So the nice part about seller finance, if you can negotiate it, you can actually get very low interest rates, 2%, 3%, or even no interest rate at all. That's the beauty of it, is that everything's negotiable. The thing about it is that you can acquire, one other benefit is you can acquire a property with little to no money down, just depending on how well you negotiate. But one thing I really like about a seller finance deal is that there is a very simple underwriting process. And it may not, in some instances, there's no underwriting process at all. Basically, it's based on reputation. It's based on the ability to negotiate, the ability to work out a win-win. But when you go to your traditional lender, you're going to have to provide bank statements, W-2s. You're going to have to go and get all these diligence checks, multiple application forms to fill out, very lengthy closings, lots of diligence and things of that nature, which they just take a long time. They take a long time. There's a lot of closing costs. You got to pay the realtor fees, you got to pay bank fees, all those kind of things, and you can really save a lot of money by utilizing owner financing. So I like it a lot. It's a tool that I've used in the past, and it's actually helped me a lot to expand my business much faster than going the traditional route. If you're trying to do a seller finance deal, you want to find an owner who owns that property traditionally typically free and clear. In other words, that there's no mortgage on the house when you go to pursue it. And some of the sources for those are going to be folks who've had that property obviously for a long time. It could be a landlord who's fully paid it off and literally and they're just generating total cash flow on that property minus their typical expenses, but they own that property free and clear. And you might say there's nobody out there like that, but believe it or not, 30% of Americans actually own their homes free and clear. So there are investors who own their homes free and clear. There are people, ready to sell, ready to retire and move on. There might be investors who are just, ready to kind of go on to still get passive income and still, but they don't want the day-to-day obligations of owning that property. So they're out there. And the thing is though, this model typically works best with off-market property. So if you're going through a realtor through MLS, that's probably not going to be a good candidate for seller financing. But then, the thing about it is, you can find these folks through direct mail. You can find these folks through other investors, and the thing that I think that's important is networking, and as a real estate investor, you got to get out and meet people. You got to talk to people. You got to tell them what you're trying to do, and through the concept of networking, and telling folks where you're after and just asking good questions and figuring out what their motivation is, you can find people out here who are willing to work with you and who because everyone wants something different from a deal. Folks are not just they're not just motivated by a big payday, right? Some folks are motivated more so by getting their money consistently over time, and they don't want to lose that cash flow. So they are great candidates for seller financing types of deals. I basically found out my first seller finance deal through someone who I bought a house from previously. Then I went to buy another house from them, and I basically told them, was like, hey, I want to take the house on and need some work, and this is a good candidate for seller financing. If you could hold a note for about 2 to 3 years, that'll allow me to upgrade the property, pull the money out, and basically pay you off in a few years. So, they're out here. And then once you start dealing with, other investors, they're also really good candidates as well. So I think they're out there. Finding other investors, even from the standpoint if you're using some of the direct mail methodologies, they're using some different softwares. You can look up the owner of a property and figure out how much equity they have on the house. You can also figure out, if they're out of town owners. Those are really good candidates as well, because that owner may be living in another state and having to maintain a property. They still want the cash flow, but they probably don't want the hassle of dealing with a property that's in another state. So that's another good another good candidate that you can use to find and to work with. So how do you set one of these things up? So once you found the person, once you've negotiated, right, you got to figure out your terms. What's your rate going to be? Are you going to be doing a low rate, 1 to 2%? Are you going to be up to 7 or 8%? What's going to be a win-win? What's the payback period? Are you going to do short-term or long-term? Are you going to do late fees if you don't pay right on time? What are the termination clauses and those kind of things? You're gonna have all that stuff drawn up in a basic promissory note. Any lawyer can draw that up for you. You can get them online. I don't really recommend you do that. I recommend you get one that's done by a lawyer. Get the MS Word version of it. That way you can change it down the road, down in the future. But get your promissory note drawn up, and things like that. And I typically work with a title company. So I work with a local title company down in our area. Basically, I just send them what we're working with. They contact my my seller, and then we basically come in, draw the documents up, and they do the title search. We put insurance on the property, all your same things you're going to do. Get home inspections, do the diligence steps. But right now with the one big difference is like I said, you're cutting out the bank, you're cutting out the realtor. Nothing against my realtor friends. I love you guys. You do great work. But sometimes in the off-market world, you can kind of save yourself some time, hassle, and money, and then speed. I think one of the biggest benefits of seller financing is definitely speed, right? So you don't have to go through some of the hassle, some of the steps through the traditional banks, and you can expand your business even faster. So again, it's a simple process. I went to the times I've closed on a seller finance deal. 15-20 minutes, I'm in and out of the closing office. It's amazing. Doing the traditional route, I got a stack of papers that thick to sign. But, nonetheless, this is another tool you can add to your toolbox, as you network, as you talk to people. Ask them if they're willing to hold the note. Ask them if they're willing to become the bank. As you, share the benefits of it, some people they're gonna say, yeah, I'd love to do that, because they're gonna come out well. If you think about it, the opportunity to be a bank is a phenomenal one, right? So this is just another tool I wanted to share with you guys. I pray it's been a blessing to you. Wanted to just give you another tool for your toolbox. If you got any questions, make sure you post them down in the comment section. We'll make sure we get them answered. And until the next time, this is what I have for you guys. I pray this video has been a blessing to you. God bless. This is Marseille, aka the Property Pastor, signing off until the next time. God bless.